Welcome to The Call, an exclusive conversation hosted by the Chamber's Global Intelligence Desk. We're delighted you are able to join us. Please note the views of our guests today are not necessarily those of the Chamber, but we hope you will find those views as valuable as we do. Let's get started. Good morning and welcome to The Call, brought to you by the U.S. Chamber of Commerce here in Washington. I'm your host, Jay Sapsford, and here's the question of the moment. Is China suffering a balance sheet recession? China plays a pivotal role in the global economy, yet few agree on why the world's largest trading nation is struggling. Today's guest offers, in my opinion, the best explanation. China is suffering from a balance sheet recession. What does that mean? Chinese property values crashed after the burst of a massive housing bubble starting in 2020. That left families and businesses with lots of debt. Now, all across China, borrowers are paying back their loans instead of spending or investing. That spells trouble for the economy. Let me explain. Imagine a family earning $1,000. It will put $900 back into the economy in the form of rent, groceries, or other such payments. Usually, the remaining $100 would go to the bank, which then lends it out for more investment and spending. If the family owes money, that $100 goes to paying down debt, and that's the right thing to do individually. But what if everybody owes money, wants to pay it back, and nobody wants to borrow? When households, businesses, everybody is focused on paying down debt at the same time, money gets stuck in the bank, less money circulates, and the economy suffers. Even if the government lowers interest rates to stimulate demand, the normal response to a recession, few are willing to borrow and invest because everybody is busy paying down debt. This is called a balance sheet recession. So what can be done? Our guest today is the economist who first identified this problem in Japan years ago. He says the government must step in, borrow, and spend to stimulate growth. Why? Because right now, nobody else will. It is my great pleasure to welcome Richard Koo, Chief Economist at Nomura Research Institute. Richard, welcome to The Call.
Oh, thank you for having me.
Now, Richard, you are credited with first diagnosing the unique set of circumstances we see going on in China, but in a different country and in a different place. And I just wonder if you might be able to walk us through what you saw and when.
Okay. I was happily doing economist job at the New York Fed when I was headhunted by this Nomura Research Institute in Tokyo. And that was back in 1984. And the Japanese economy was in a bubble, was doing great. They thought Japan was number one in the world. And then on 1990, the bubble burst, asset prices collapsed, and Japanese bubble was huge. This Imperial Palace Garden in the middle of Tokyo, which is it's not a very large park, was worth the entire state of California. So you could imagine how big the bubble was. And when it collapsed, the economy began shrinking. But Bank of Japan at that time said, "Not worry, we're going to bring interest rates down," and brought it down to zero. And nothing happened. And we were all shocked that with zero interest rates, fiscal stimulus, all of that, the economy continued to struggle. And it took me almost 7 years to come up with this whole concept. When I looked at what Japanese companies are doing in this environment of zero interest rates, and I noticed that they were actually paying down debt, not borrowing money. And we were never taught in universities that companies are supposed to pay down debt when interest rates are zero. So I had to think, what would have caused the companies to pay down debt? And of course, if they have balance sheet problems, they have to pay down debt. If you are technically bankrupt with asset prices down, but the liability is still up there, the gap is your debt overhang. And then when you put that into the macro context, as Jay already explained, in the national economy, if someone is saving, someone else has to be borrowing money. And in the usual economy, central bank will move rates up and down, make sure that all the saved funds are borrowed and spent. That's the textbook world. But right. Japan was already out of that in the sense that central bank bring rates down to zero. No one's borrowing money. Everyone is still paying down debt because they all wanted to come out of debt overhang as quickly as possible. As Jay said, everybody's doing the right things, very responsible, very honorable things. But taken together, we enter the world of fallacy of composition where individually everybody's doing the right things, but collectively they get the wrong result because the economy will start shrinking from the example he gave from 1,900 and 900 to 810, 810 to 730. And when you look back at the history, this is what actually happened during the Great Depression in the United States. After October 1929, everyone in the U.S. started paying down debt all at the same time. Government at that time did not understand this thing. They also tried to reduce their budget deficit under President Hoover, and the whole thing just collapsed. The United States lost 46% of its GDP in just 4 years with this 1,900, 810, 730 process.
And so that was a devastating time in U.S. history. Since you identified this in Japan, there's been examples of balance sheet recessions elsewhere in the world. I wonder if you could just quickly highlight where else this has occurred in recent years.
Well, after Japan 1990, the next candidate was actually Germany, because Germany, the dot-com bubble was huge, and that burst, and the German household sector stopped paying down debt, stopped borrowing money altogether. But luckily, Germany was within the Eurozone, and other countries in the Eurozone were not affected by the dot-com bubble, so they kind of saved the Germans. But then in 2008, housing bubble burst on both sides of the Atlantic, and the entire Eurozone plus the United States all fell into balance sheet recession. And so you can tell that Chairman Bernanke brought rates down to zero very quickly, thinking that would then get the economy to move. But as we all know, the United States also suffered many years of very slow growth, very low inflation rate, even though Chairman Bernanke also added massive amount of liquidity in the banking system. If we believed in what Milton Friedman once said, that if you pump the money, the inflation should pick up, well, that Japanese experience from 1990 and the American experience from 2008 proved that if there are no borrowers, monetary policy is largely dead in the water.
Okay, so in China right now, your contention is that we are suffering from the same shortage of borrowers, but there are differences between Japan and China, to take two countries to compare here. In Japan's case, it was largely commercial real estate, but in China's case, we're talking more residential real estate, right?
Yes. But the U.S. case was also residential real estate, and we ended up with something very, very similar. Monetary policy down to zero interest rates, quantitative easing. Still, inflation rate failed to pick up, and the economy continued to suffer.
Okay, so when everyone is paying down debt at the same time, presumably that money is going back to creditors, right? That's the financial institutions, the same ones that would be lending. What happens to that money when they're paying down debt?
Well, there are always those people, fund managers in banks and financial institutions, who are supposed to put this money somewhere so that they'll earn interest. So they try to find the borrowers, but collectively they cannot, because there are no private sector borrowers out there. And so one of the key characteristics of balance sheet recession is that interest rates come down to ridiculously low levels because there are no borrowers.
I see.
At the same time, government bond yields also come down to a ridiculously low level because that's the only borrower left. So if you're a fund manager, you're stuck with these funds coming back to you, both from the newly generated savings, people paying back, and the central bank trying to get the economy to move. So they're going to pump money into the system as well. All these funds come into the fund managers in financial institutions, but there's only one borrower. And so they ended up lending to the government. And so bond yields came down ridiculously in the United States, in Japan, and now that is happening in China as well.
So you're saying then that all of that money ends up in the government bond market, and that drives down when the demand, as prices go up in bonds, and for all the demand that are coming from these financial institutions, no place else to put that money. That drives interest rates on the long end of the bond market down.
Right. And that's the bond market's way of saying to the government, this is no time to cut budget deficit. This is the time to increase the deficit. Because if government borrows the first $100 and put that back into the income stream, I spend $900, government borrow and spend $100, it's $1,000 against my original income of $1,000, then the economy will remain stable. And that's basically what Japan did for the last 20-some years, of almost 30 years. And as a result, even though Japanese real estate prices, commercial real estate, by the way, fell 87% nationwide, not just a little corner of Tokyo, the entire country, Japanese GDP never fell below the peak of the bubble for the entire 34 years since 1990. So if you do this correctly, you can keep the economy going, allow private sector to pay down debt, and you actually come out of this thing.
Okay, so the Chinese government has taken a bunch of stimulative measures, and there's been this effort to try to increase investment in targeted industries, electric vehicles, and technology. But more broadly speaking, is what they're doing enough right now to get the economy going in? Are they stimulating enough? And if not, what needs to be done?
Well, starting late September, they did announce a whole series of measures, which is far better than nothing. But when bubble burst, we end up with two problems: the financial crisis and the balance sheet recession. Financial crisis affect the lenders, balance sheet recession affect the borrowers.
I see.
So many of the measures the central bank announced, Chinese government and central bank announced after September, were really financial stability measures. And as such, they are, of course, far better than nothing. But in terms of filling that $100 shortage in borrowers, I'm afraid there's only one policy that they put in that is so far moving in the direction, and that's a policy that says government will support developers who will complete the unfinished apartment houses with this very low interest rate loan that they are going to provide. And that way, if the developers who stop building these or stop finishing the apartment projects, if those projects wins the government approval, put on the whitelist, then government they can get the money from the government to complete the project. That way, the money actually goes out of the banking system, enters the real economy, and that part is good. But given the size of the Chinese economy, what they have announced so far, I'm afraid, is far from sufficient. They need to do a lot more.
So that means borrowing that money that's stuck in the banking system and investing that in the economy in ways that's going to spur growth, right?
Right. So in a situation, incentives to increase consumption or investments, I'm afraid, are not going to be very useful because private sector is actually minimizing debt. And so if you give them tax cards and vouchers to spend money, whatever the money that private sector save will be used to pay down debt. So it's not going to fill this deflationary gap. But if the government borrows and spends it, then you can be sure that this deflationary gap is filled. And that's what's needed during a balance sheet recession, because if the government fails to do it, economy will be contracting very, very rapidly.
So this focus on trying to increase borrowing, it seems to be is kind of tied to the fact that China has been an investment-led economy and not a consumption one. Its investment levels are much higher than world averages. Its consumption is much lower. And there has been some talk, and certainly at least some lip service from the government saying that we need to increase consumption. How does that dynamic fit into a balance sheet recession?
Well, they can try, but my advice to them is that it's not going to be very effective because whatever, if you give them tax cuts so they have money to spend, they will use the money to pay down debt because that's the first order of business for private sector at the moment. If you are technically bankrupt, you have to come out of that as quickly as possible because otherwise your suppliers, realizing that you're actually technically bankrupt and may walk into Chapter 11 any minute, they're not going to give you trade credits. They want everything in cash. And once you're put in that situation, your business is finished. And so private sector has no choice. But only government can do the opposite of the private sector and make sure that all the safe funds are borrowed and spent.
Now, in the case of Japan, there was a pretty significant demographic issue in that society was aging pretty rapidly, and as people tend to age, certainly I spend less than I used to when I was younger. That was one of the dynamics that was going on in the background in the Japanese economy during the 90s and the aughts. In China, my understanding is that their population has started to decline now, at least from the UN statistics, and it's been going down for 2 years. So that suggests that there's aging going on in the Chinese society as well. How does that dynamic play into a balance sheet recession?
Well, let's compare the Japanese and Chinese situations here. Japanese population was aging. There was no question about it. But the Japanese population actually peaked 2009.
Right.
That's 19 years after bursting of the bubble in 1990. So during that period, Japanese population was still growing. And so you cannot really blame everything on the demographics in Japan. It's really the balance sheet part that killed the economy, not the demographics.
Right.
But in Chinese case, the bursting of the bubble and decline of the population happening on the same year. This is devastating because for Chinese real estate market to stabilize, people must have this feeling that the price has fallen enough. You will not go wrong if you enter the market at this lower price. But how do you come up with this bottom price when people are all talking about the population declining, demand for housing falling? And so the price will have to fall much further than in a similar situation with the population increasing for Chinese real estate market to stabilize. And of course, it hasn't stabilized yet. And the population issue will probably keep this real estate market in very difficult situation for foreseeable future.
So what you're suggesting is that China is really going to be suffering from a lack of demand from the consumer sector. And that lack of demand, to my mind, always suggests deflationary pressures building up in the economy. We saw that Japan had deflationary pressures build up throughout the past 30 years. I just wonder if that might be something. I mean, we're already seeing, falling bond yields are often a sign of deflationary pressures building. We see some of the purchasing prices falling. We see some of the consumer prices showing signs of disinflation, if not outright deflation. I wonder how deflation plays a role in all of this.
Well, I think China is going through exactly what Japan is going through, or what the United States and Europe went through after 2008. But deflation is the result, not the cause of the problem. The cause of the problem is the balance sheets. And so sooner you repair the balance sheets, the faster you would come out of this thing. And in one area, China is ahead of Japan 30 years ago in the sense that so many people in China already aware and are talking about this disease called balance sheet recession. That's very different from Japan 30 years ago. When Japan fell into one, no one understood what the disease was, including myself. Why zero interest rates producing nothing? And why fiscal stimulus and those will only work when the government spends the money. But when the government removes the stimulus, instead of having this pump priming effect that we all learn in universities, economy tanks again. All of that is coming from balance sheet problems, the private sector. Once you know the disease, you feel much better, right? Okay, if you do these things, you will recover. Maybe it will take 5 years or 10 years in some cases, but you know you recover. In the Japanese case, 30 years ago, we were completely lost. So that made people even more depressed. You go to a hospital, talk to the best doctors in the world, and they still cannot tell what's wrong with you. Then you become very depressed. In the Chinese case, that is not happening. Well, I don't know. To some people, it might be happening, but there's so many people talking about balance sheet recession. So many of my books did very well in the Chinese market. So I know that they know what the disease is. The question is whether the government is willing to put in the necessary fiscal stimulus and in a continuous fashion to make sure that our private sector will have an income to repair its balance.
All right, our audience has had their morning shot of informational espresso this morning, so we'll leave it there and tackle the day. Let me thank Richard Koo, Chief Economist at Nomura Research Institute. Richard, thank you so much for swinging by and talking to us. Appreciate it.
Thank you. Thank you for having me.
And a warm thank you to you, our members, for joining us today for this episode of The Call. If you have a theme you would like us to cover, reach out to us via the email on the screen or join the conversation on LinkedIn. If you've missed an episode, you can see the replay on our website or catch our podcast edition anytime on Apple, Spotify, or wherever you get your podcasts. This has been The Call, brought to you by the Global Intelligence Desk of the U.S. Chamber of Commerce.